Good morning, ladies and gentlemen, and a very happy new year too. I think I'm still allowed to say that. It's not halfway through January yet, but a very happy and prosperous new year to you all. Let's work very hard as your trusted financial partners to provide that prosperity. I'm delighted once again to be joined by my esteemed colleague, Tom Beckett, my co-chief investment officer here at Canaccord, for this market update webinar. We've got lots to talk about, so just over to Tom briefly for him to say hello, and then we'll crack on.
Well, greetings all, and to reiterate that Happy New Year. Slightly different setup today, actually. I'm in sunny, I haven't been able to say that for a while, at Royal Tunbridge Wells, recovering from a hip operation. And sort of point out, Richard, I do have my crutch here to hand, and I'm back in the office very, very shortly. So any very difficult questions this morning, you'll be within reach when I come back in next week.
Look forward to it. Thanks, Tom, and so it'll be great to see you back. So let's crack on, because we've had a really good year in 2025. But how did that end up from a market perspective, Tom?
You started with a softball question, because talking about the past is very easy. As we go on to talk about the future, we have to point out prediction is always very, very difficult. But last year was a really good year for markets generally, and I think it's a very good example, Richard, of why we always try and encourage our clients and investors broadly to ignore the noise, ignore the nonsense, and focus in on the fundamentals. If you did that last year and didn't obsess too much about the geopolitical crises, the ongoing political events, let's put it that way, the economic uncertainty that many people were talking about, and just focused in on the fact that the global economy was growing, corporate profits were growing, inflation wasn't a massive problem, interest rates were being cut, then you'd have been on the right side of the trade. And I do have to point out that when we did one of these webinars, and I think we had one of the highest attendances we've ever had, which tells you that markets were somewhat skittish at the time back in the second quarter of last year. You very much suggested that in equity markets in particular, people should stay the course, ride through the volatility, and that ultimately you'd be rewarded for doing so. And that was the case in equity markets last year in particular. A different shape and a different direction than we'd seen in the few years prior to 2025, where beforehand the US equity market was the only game in town. But last year was a year when some of the previous laggards, the green line here, which is Europe, the red line, the emerging world, and the blue line, the much maligned UK market, all produced very healthy returns and closed some of that valuation discount to the purple line, which was the US market. So overall, global equities last year up roughly 15%. But the purple line, the US market, lagged in no small part due to the performance of the dollar, which was weak through the first few months of last year. So last year was really good from a broad equity market perspective. But as we look at the next slide now, you can see from a sectoral perspective, things were really quite interesting. The one line in particular that we would point out is the omnipotent and gargantuan tech sector, the white line here. And you can see that we got to the point last year where there was a huge amount of pessimism and misery towards the tech sector. If you remember back in April of last year, the common consensus suggested that the era of tech dominance was over and the US was staring down the barrel of not only an economic recession, but a deep equity bear market. That, of course, proved to be a very good buying opportunity. When consensus swings too far in one direction, you often want to take the other side of the trade. But the tech sector, effectively from April to the end of the year, performed extremely strongly. But a couple of other things to point out from the sectoral perspective. The second half of the year was a period when economically sensitive or cyclical sectors did quite well, things like the banks, industrials, materials. That hinted at a better economic outcome as we came into 2026. That's obviously good news and justified some of the performance that we saw in equity markets. And one final thing to point out, and we'll get on to talking about why this was a disadvantage last year, but potentially an advantage this year for portfolios. That's the rather meager performance of the yellow line, consumer staples, which produced no positive return last year, and the healthcare sector, which up until mid-September was performing miserably, but then actually had a very good, strong end to the year. And we believe this contrarian opportunity and this recovery play could power portfolios this year, but we'll save that for a bit later on in today's discussion. Finally, as we just sort of, seal the deal on 2025 and look at the final scores, the next slide just shows that it was a sort of slightly different situation last year in markets, in the sense that bond markets finally went from being a hindrance to returns in 2022, 2023, and 2024 to being a help for returns last year. Now, I'm pleased to say that our clients' fixed interest allocations at Canaccord have actually had a really good 3-year experience through 23, 24, and all of 25. But the difference was last year that we went from having headwinds in fixed interest markets, which was core government bonds performing poorly, to tailwinds where government bonds performed well, and that lifted all of the fixed interest markets prices. And so whilst it was another year where the purple line, riskier bonds or credit, performed better than anything else, it was a year where finally portfolios got some broad help from bonds. And long may that continue. And we'll go on to talk about today why we think that will continue in 2026.
Yeah, thanks. So that broadly, I think, aligns with how we set our stall out at the beginning of 2025. Would you agree with that?
Yeah, I think that, interestingly, for a year that was very unpredictable, from an economic sense, and when it came to inflation and when it came to interest rates, and we'll talk about those rather tedious subjects in a minute, well, I'll try and make them as interesting as possible. I think it was another year when our predictions from a macroeconomic perspective came true, and that's that's pleasing. I mean, obviously, some of the sort of different vagaries beneath the bonnet of financial markets were somewhat perplexing at points, but ultimately the base case came true. And I think as we head into this year, we would point out that once again, many people are talking about it being a year of unpredictability from a economic perspective. But I think we do have some strong views, and I think these views will be upheld. I think from the perspective of the economic backdrop, we would be, perhaps I'm worried saying this because I'm well known as being somewhat a pessimist, but we're actually slightly more optimistic than most people. And I think if you think about it from the view of the American economy, where there's lots of polarizing commentary on President Trump and the Republican administration and all the various things that are going on. But ultimately, again, you have to ignore the noise, ignore the nonsense, even if it's very, very difficult, and focus in on the simple facts. And the simple facts are, in the US, through the One Big Beautiful Bill Act that was signed into law last year, we're about to see enormous tax refunds and very big tax giveaways and good treatment of profits for companies, in terms of turning their profits, their revenues into profits. All of those will, I think, support consumption this year, and that leads us at Canaccord to have a more optimistic view on the US economy this year. It's not without risks, there's no doubt about it, and with this sort of sclerotic approach to the Trump administration, I don't think we can ever rule anything out in reality. But this year, with those various different spending drivers, fiscal support ahead of the US midterm elections, spending on, they call it soccer, the Soccer World Cup, which is going to be very, very large and a real consumer feast in America, and indeed the celebrations around the 250th anniversary of the signing of the Declaration of Independence. You put all that together, as well as increased military spending and all the spending that we can talk about later on data centers and various things like that, it's hard to predict a recession here in the US, and we would slant more positive than most people. I think when you combine that relatively positive backdrop, the US, alongside China, which is still an enigma wrapped in a riddle, you see a situation where things are not getting worse, but it's hard to see them getting much better. So broadly dull, but not disastrous economic activity there. And in Europe, much was made of the spending plans of the German government, which haven't quite yet come to roost, in all honesty, or come to fruition. But still, in Europe, and including the UK, I think it'll be a stretch to say that things are great, but I don't think they're getting worse either. So I think from the broad economic perspective, Richard, I think this year will be solid but unspectacular once again.
Which is great news. Of course, one of the things we talked about through last year as being a key risk is inflation. And there was a bit of a wobble in the UK with inflation rates popping up over the year. Do we expect inflation in the UK to behave itself going forward and elsewhere as well?
We entitle it the summer hump, Richard, because that was when all of our various different services, bills, and various things like that started ratcheting higher. I've used previous examples, the Beckett household again, so won't do so here, but it was quite a painful period for us, and I'm sure painful for everyone. And I appreciate we've got an international audience, but everyone in the UK would have felt these pain. And I think also, actually, most people through the international markets also felt the pain of rising inflationary trends through last summer. But I think that's now backward looking. And again, we have to caveat this by saying that there's a lot of, inverted commas, stuff going on. But ultimately, I think what we're seeing at the moment are disinflationary tendencies on both sides of the Atlantic. And the big problem with the UK last year was the obviously inflationary budget put in place by the Labour government back in late 2024. The budget of late 2025, I think, was pretty miserable and didn't really confirm the Labour government's pursuit of growth, growth, growth. In fact, I would say it pretty much did the opposite, but let's leave that to one side for a second. There was nothing obviously inflationary within that. So when you combine that with some of the measures the Labour government has taken to reduce down energy bills, and also some of the elements that we're seeing in things like the oil prices, this should lead to, I think, and the team mechanical think, a quite sharp fall in inflation through the year as we get down to roughly 2.5%. So I think the inflation backdrop in the UK is better. Now, I have to caveat that by saying that a lot of that goes down to quite, pronounced economic weakness and no real sign of an economic recovery or renaissance. But lower inflation is good news for consumers and good news for central banks. We'll talk about interest rates in a second. But first of all, on the other side of the Atlantic, remember there was a lot of talk at the start of last year as Trump's tariffs started to be put in place, that this was going to be a real problem for the US economy, a real problem for the US Federal Reserve. We're going to see substantial higher rates of inflation. None of that really came to pass. I would argue that rather than it contributing towards higher rates of inflation, the tariffs meant that inflation didn't come down fast as it might have done. But the recent inflation data in both the UK and the US is pointing to softer inflation outcomes, which means on the right-hand side of this chart here, we would still expect to see another couple of interest rate cuts in the UK and the US this year. We're not entirely convinced on the timing of those cuts, Richard, but we expect to see another 2 this year. And broadly, as you put that together, the global economy has a situation where economic growth is solid but unspectacular, inflation is moderating, and interest rates are being cut. And as we go on to talk about markets a bit later, typically that is a supportive environment.
Yes, indeed. Absolutely. We had our last webinar just before the UK budget, and some of you may have seen our financial planning team discuss the budget subsequent to it. And you did allude to it in terms of it not perhaps being quite as negative as some people had feared. Where do we see the UK? It's still a large part of our clients, many of our clients' portfolios, less for some more international clients, but for our UK-based clients, it's still a significant part of their portfolio. So where do we see the UK post the second Reeves budget?
Yeah, and I don't often correct you, and it's a slight nuance, but rather than thinking about it being less negative than expected, I think it was probably less inflationary. I don't think any of us really picked up any signs of obvious positivity within the budget, and I think if anything, it sort of messes up the situation a bit further and consigns us to a period of high taxation and low growth. I mean, you're right to point out. I mean, it could have been worse, but it's quite a high hurdle these days when it comes to UK tax policy, which, as you can see on the chart here in front of you on the left-hand side, is now proving to be quite problematic. And you've told me this many times before, and I'm not a believer in big government, and big governments do not spend money well. Money is much better left in the hands of consumers and companies to invest and allocate that money appropriately. They've got less chance to do so because the government is taking an increasingly high amount of the UK company and corporate earnings as taxation. And this is a problem. And you can see on the right-hand side of the chart why Rachel Reeves had to come back for more, because all the fiscal wiggle room had gone. So taxes, whether bluntly or stealthily, had to go up. And I think the problem is, Richard, this does consign us to a period of economic stagnation, in all honesty, in the UK. Let's hope that things improve, but at the moment it's quite difficult to do so. So less inflationary, still not great for growth is the way that we would describe the budget, and still no signs yet of an obvious economic renaissance in the UK.
Thanks.
I think just one final chart, actually, this might also help the picture, explain the picture for clients. You can see there is a difference here on both sides of the Atlantic, and there's a lot of, as I said, polarizing political commentary about what's taking place in the US. And again, ignore the noise, ignore the nonsense when it comes to client portfolios and financial markets, and just think about the basic facts. The UK and US governments are presently taking a very different approach to trying to get out of the common debt problem that we have. In the UK, we are effectively adding to the problem by reducing the ability for the UK economy to grow, even while spending continues and taxation therefore has to rise. In the US, they're taking a different approach. And I'm not saying one approach is right or one approach is the other is wrong. We'd all have different philosophical views about economic policies. But in the US, the Trump administration is clearly going for growth to try and grow itself out of the big debt problem it is. So lots of other things aside from that. But that's the key difference between what we're seeing in the UK and the US. In the UK, this probably does equate to a period of economic stagnation. In the US, it's a very interesting fiscal experiment. I'm not saying one will prove to be right or wrong than the other, but I suspect it feels a lot better in the US right now than it feels in the UK.
Yes, indeed. And before we hand over to you, ask me some questions. I'll just ask something about current events. Obviously, last year we had lots of geopolitics to keep us entertained, if you like, and it was what we've called the quintessential turbulent 20s year. But we've started this year with Venezuela. We have what looks like potentially a fundamental shift in what's going on in Iran, with dreadful images seeping out there. And of course, now Greenland is in apparently the Donald Trump's sights. Where do we feel this leaves us?
Yeah, I'm going to contradict myself as I often do. You can't ignore it, but you should ignore it to a great degree. It creates a level of volatility and uncertainty which will support our view that this year there's going to be a lot of volatility in markets, but that should not dissuade us away from the fact that we think we'll make positive returns in equities and bonds, and we can talk about what sort of returns those might be later. But I think when you combine the geopolitical issues of the day, of which there are many, some utterly farcical in some senses and some quite obviously tragic in the case of what's taking place in Iran. When you combine those alongside the fact that we have things like the US midterm elections this year, in the UK, whichever elections are being allowed to take place, we have various different local elections and things like that. All of this is going to add to the backdrop of volatility and uncertainty that we are expecting to see. But a couple of things on that. It has been like that for quite a long time. And the last 3 years have been very rewarding for client portfolios. And we expect this to be another year of that taking place. And the second point, which I think is quite a good segue into thinking about what we're expecting from markets this year, volatility is often treated as the enemy of an investor. We fundamentally disagree. Volatility is the friend of an investor. It allows us, for example, in our portfolios now, which are quite up in quality and focused on dependable defensive investments, a period of entrenched volatility and sharp market falls will allow us to rotate into some areas which perhaps perform poorly through that. So we're hoping for volatility this year, Richard, rather than hoping to avoid it, even if it makes your or my life more difficult, and hoping to use it to our advantage as we progress through the year. So there we go. Please, I won't hit you with my crutch when I come back in, Richard. That was relatively manageable by comparison to previous events. So let's get on some more difficult questions now about financial markets. And last year was a very good year for equities, inescapable fact. Does that mean that the equity market, bull market, is done, or is there room for positivity based upon what we should expect to see from corporate profits this year?
Yeah, this is a great question. And of course, it wasn't just last year, because 2024 was also a very, very strong year for equities. And indeed, the last part of 23 as well. We saw the beginnings of a wider recovery than just a few of the tech names. So it's a natural question to ask, is there more to go for? But the way we set things out already should sort of help us answer that, because we do have economic growth. We do have strong expectations for more earnings growth. And the reason that's important, for example, beginning of last year, would have said the US was looking a little bit expensive. It's actually cheaper this year, having gone up just shy of 15% in sterling, a little bit more in dollars, over 2025, because earnings have gone up by more than the market did. And that means that this is a healthy bull market in equities at the moment. Ally that with the expected interest rate cuts we've talked about, the fact that governments aren't going to be cutting back on spending, which means the merry-go-round can continue. And of course, the hope for productivity benefits from AI, which we may come on to in a bit. All of this means that actually, with a US market still looking a bit pricey, honestly, but a little bit less pricey than it was 12 months ago, other markets have done better this year, perhaps haven't benefited quite from that earnings uplift, but then by no means out of valuation ranges, historic valuation ranges. So I think with those tailwinds behind markets, we can continue on for a bit longer in equities. I'm glad to say.
What do you think about overall sentiment, Richard? Because it's interesting if you think about some of the previous episodes that you and I have worked in financial markets. There's been an obvious element of complacency, but there's been a lot of talk recently about an AI bubble. And it's interesting, perhaps by comparison to some of the previous episodes you and I've worked through, is that people are trying to identify the issues with it. And there might well be issues with the valuations around it. So where do we think about the AI situation and how we now expressing this in our portfolios? Because many people are making out to be the most egregious valuation mispricing in 20 years versus some are expecting it to be utterly transformational from the perspective of markets and the economy. So where do we sit and how are we playing AI in portfolios?
Yeah, the AI bubble question is one which is much exercised in the press at the moment, and for reasonable, for good reasons. There are a number of red flags out there. We've had lots of warnings from the likes of Jamie Dimon, from Andrew Bailey at the Bank of England, even from Michael Burry, famous from The Big Short, for those of you who've either read the book or seen the film or both. So there are people out there who are identifying some excesses, and you can see them. There's circular investing. So Nvidia invests in companies that buy Nvidia chips so they can buy Nvidia chips, that kind of thing. Special purpose vehicles, accounting changes, big price movements. All of these are sort of symptomatic of a bubble kind of environment. But if we compare it with the most recent technology related bubble, which is about, of course, 25 years ago at the end of the 90s, the valuation levels now are far less aggressive than they were then. And that's because the key players are making enormous amounts of money, whereas in the late 90s, it was all hype and no money. Here it's a lot of hype, but lots of money. So I think that it is different in that sense, but we've got to stay alert to this because those red flags are out there and they're genuine. So the way I like to think of it is, yeah, we're in a sort of proto bubble, the beginnings of a bubble. The bubbles can inflate for quite a while. And we mustn't forget, as I said, that actually at the moment, the key leaders in this are generating very good profit numbers for investors. So actually, the bubble is, if it is a bubble, is a little bit more self-sustaining than it was last time. So how do we play it in our current portfolios? Well, this is this being AI, this is a secular shift of the most profound nature. And so even though some of the big players are a little bit expensive, we do think we should have some exposure. So we do ensure that we've got exposure to those names, not perhaps as much as the market as a whole, but exposure nonetheless. Where there's greater value for us is slightly lower down in the technology space, by which I mean lower down in size, where we think there are interesting plays to be had. So actually we're a little bit overweight that part of the technology market. And increasingly, people are beginning to identify or try to identify the winners of AI who aren't the people who produce chips for AI. So how that filters through into media companies, into consumer electronics companies and the like, further down the scale, industrial companies as well. We're seeing a lot of industrial names do very well at the moment because it's not just technology companies that are benefiting. So there are lots of ways we're playing it. We are cautious but optimistic, I think it's fair to say.
Great. Perhaps we start putting that into the context of some numbers, and this next slide I think is useful in that regards, because I think trying to think about the world markets and where there are opportunities is useful, because the US market has become, I'd use the term omnipotent earlier, it's gargantuan in size by comparison to other markets. But perhaps just sort of a few comments on valuations and where we see opportunities outside of equities to be useful, because we've been asked a couple of times now by clients and introducers about the table on the right hand side, which shows valuations that you could perhaps discuss. And people say, well, what does this really mean in terms of my money? And I think perhaps, I'm sure you'll agree, that what this is telling us is perhaps there's still money to be made in equities, but returns will probably be lower in the future than they have been in the recent past. Is that your own assessment? And thereafter, where do opportunities in equities exist away from the US?
Yes, I mean, and it's good news that there are those opportunities away from the US. Look, the US, as you say, is huge, and it's two-thirds approximately of the world equity market. And within the US, the top 10 companies are over 40% of the US. So highly concentrated, enormous companies, which is why we want to participate in them. Enormous and successful companies, and we want to participate in that. But valuations, as we said, are pretty full, really. The Mag 7, as you can see, currently on a 12-month forward PE of about 30 times. Which is, as I said, is about the same, in fact, a little bit less than it was 12 months ago, but is still extended by historical terms. Still a way to go before it gets to the high in valuations that we had in 2021, which was the period where we had 0% interest rates. US more widely perhaps has that squeezed up in terms of valuation. But really, we see plenty of areas further down this list on the right-hand table where there are opportunities. If you look at emerging markets, for example, you can see China, the largest emerging market by some measure, looks at reasonable value. EM excluding China also seems to be reasonable value. Europe ex the UK and the UK themselves both look pretty decent value. They have had great 2025s, both up approaching 25% in sterling, which is great to see because we've got some exposure and we've been highlighting the valuation difference between those areas and the US in the past. Perhaps a little bit less to go for, though. There's a very strong correlation over the longer term between the level of PE you invest in today and the returns you get over 10 years. And that suggests that over that kind of timescale, from here, we can see, look forward to slightly less attractive returns from equities in general. In the short term, there's no correlation between the current valuation and 12-month forward, 24-month forward, and 36-month forward returns. So I still think there's room for us to be optimistic. There are some areas geographically which remain reasonably attractive. There's nowhere in the world these days which is outright cheap, but there are plenty of places which are not expensive.
Yeah, I think those points are borne out further on the next couple of slides, and you can see as the slides come up that there are various markets around the world where on a price to sales basis things are cheaper than the US, and I think we need to reiterate the important point that you made earlier, that on the right hand side of the chart you can see the performance of large cap US equities, which went bottom left to top right through the year. Another very strong year from US equities, but ultimately, whilst profits are growing the way they have been, that's normally a supportive backdrop for equity markets. But I'm going to ask you the what if. So what if equity markets this year are perhaps not as positive as the consensus is suggesting? Earnings growth is not as positive as people are suggesting. I've seen sort of 15% penciled in for the US and for Europe, and the tech sector delivering another 25% earnings growth this year. But if that is not the case and it is more negative, what areas of protection do we have in portfolios to ensure that our clients are not exposed to those significant drawdowns, or less exposed, I should say?
Well, one of the good things about markets at the moment, and one of the reasons we still are quite happy to be fully weighted in equities, is that there are areas which have not contributed to the uptick in that we've seen in the last 2.5, 3 years. Healthcare was one we mentioned earlier, where you saw there was a 0% return effectively through 2025, a little bit more than 0%, maybe 5%. And healthcare is one of the themes that we've played for quite a long time. It's been a little bit painful in the last 18 months, but has begun to pick up now as people are looking around for areas where there is a bit of protection in equities from any kind of valuation squeeze. And healthcare definitely is less expensive than a number of the tech areas. We continue to like it. We think that the long-term demographic drivers in that space still are there. They haven't gone away. We're all getting older. Emerging markets are getting richer, and they're getting, I'm afraid to say, fatter, which means they get more unhealthy, which means they need more drugs, which is great for the healthcare system. So that hasn't gone away. Valuations are there to support other areas as well. It's not just healthcare. We mentioned staples, which was in fact a 0% return last year. We still think there are some good areas in staples, and the theme of utilities, which we would have said when we first began investing in utilities and infrastructure more generally, was primarily an interest rate play. But now, of course, energy is so required by data centers and the like that it has also benefited from that theme, from a sort of peripheral AI theme. So actually, that despite having done reasonably well, has still got room to improve further. So we continue to like all those areas, and from a sector point of view, it's not that we've got enormously rich pickings, but there are enough good pickings for us to construct nice portfolios. And those areas, because they don't have the high valuations, because they tend to be a little bit less sensitive to market movements, should provide good downside protection if it does go wrong.
Yeah, so our themes remain relatively constant to last year in some cases. I mean, just to bring it into recent context, we had our Strategic Investment Committee meeting yesterday and discussed how we reached the point of maximum capitulation in healthcare in the autumn of last year, following which we've had a really good, strong period of performance. We felt that probably staples could be at a similar point now, didn't we?
Yes, exactly so. I mean, look, staples have been impacted by the trend towards so-called fat jabs, anti-obesity drugs, because obviously staples include companies that make food, that produce alcohol, but their valuations are very reasonable, and they still are growing, despite the fact people are worried about perhaps their longer-term growth trends being a little bit lower than they were previously. So I think there are attractions in that, and that's what we discussed, as you said yesterday. So thanks, Tom. I think it's probably a bit of time I turn the focus away from equities, and let's talk about the much more exciting world of fixed interest a bit. You said at the beginning that fixed interest was a tailwind for portfolios last year. In fact, the way we've invested in fixed interest for 2 or 3 years since late 22, we've benefited more than the broader market by quite a clear margin. But it has been a couple of tricky years, particularly if you've been exposed to UK gilts. And now we've had a decent year. Is it too much to hope for another good year in 26?
And I totally contradict you, Richard. Bond markets are not interesting, and they're not supposed to be interesting. But I do realise you were being facetious, and we are trying to keep this boring as possible. In which case, I'll be mercifully brief this morning. In simple terms, actually, 2026 should be a perfectly satisfactory year for bonds. I don't think we're going to make the sort of annualised returns we have done back through the last 3 years, which followed from a generational buying opportunity in credit in the back end of 2022, as we said at the time. That felt quite painful back then saying that, but it came to fruition. But I think bond markets will produce sensible and solid returns this year, even if we see volatility in bonds like we see in equities, to a lesser degree, though, because we are trying to keep it relatively boring. Yields are attractive across the board, from 4% in government bonds, 5% in investment grade. We can still get more interesting credit-esque returns of 7-ish%. So I think when you combine the yields on offer alongside the macro backdrop we talked about of moderate but positive economic activity, moderating inflation, a moderate number of interest rate cuts, that's broadly quite good for bonds. And when you combine that alongside healthy corporate balance sheets, I think the environment ahead for bonds is perfectly satisfactory, leaning towards being, I think, really quite good. In terms of the prospective returns, you can see this on the left-hand chart here. The white line is the yield that one buys into in a bond market and or a bond investment, And you can see the purple line tracks that. The purple line effectively tells you what your future return would be on a rolling 3-year basis. So we'd be expecting returns. This is focusing on government bonds and corporate bonds for returns to be roughly between 4 and 5%. And we think that we can get more towards that 5% number through strong active selections and a little bit of credit in portfolios as well. So we're still quite positive on bonds, Richard. And when you put those together in terms of what you said about equities and I've said about bonds and think about asset allocation broadly, we're still very much strategically in line with long-term asset allocations, or in a more technical parlance, neutral, although neutral doesn't mean that much to many people. But what that tells you really is that we like both bonds and equities, and believe the two asset classes combine together well, and therefore we should be balanced across our portfolios to ensure a full weighting in both. A little bit of alternatives around the side, but at the moment, with both bonds and equities being quite a sensibly priced, full but fair was the terminology we used. Actually, bonds and equities, those two big twin engines, probably do a perfectly satisfactory job, albeit with a small allocation to alternatives as well to provide that diversification. I think realistically, Richard, we have to point out that last year was a really good year for markets. And 2024 was a perfectly satisfactory year as well. And 2023 was a year of recovery. We wouldn't be surprised, I don't think, to see returns lower this year than last year. And those returns will be harder won. But ultimately, we do believe that both bonds and equities will be volatile, but ultimately produce a positive return. So just to conclude, before we take questions that have come in from the audience, last year, as you described it, was the quintessential turbulent 20-year. Geopolitical crises, political uncertainty, question marks over the economy, question marks over inflation, and question marks over everything. But ultimately, the economy grew, corporate profits grew, and markets made positive returns. That's been the tale of the tape, really, for this turbulent decade so far as a whole. This year, as we think about it, we're expecting moderate economic growth, moderating inflation, some interest rate cuts, corporate profits to grow, lots of geopolitical excitement. So I think our bias is towards a positive portfolio outcome, even if we do have to monitor things like the employment backdrop in the US and watch out for any early signs that inflation's coming back to the system. So if that sounds, you to use the term cautiously optimistic, I would much prefer that than anyone thinking we're complacent. We're definitely not the latter. Portfolios continue to be a balance and offer diversification, and we believe there's a sensible approach between those investments which should be attacking and those which should be defensive. We think that's very much the right way to plot way through what could be a turbulent but ultimately rewarding course in 2026. Thank you. Let's get to the questions. I'm going to go first.
All right.
I've seen the questions. There's some difficult ones in there. I don't know where to start, actually, Richard. Actually, let's start with the perhaps most exciting market so far this year. Precious metals. We've had different views on precious metals for various different parts of our career, but understand why gold and silver have performed well for the last few years. Gold has hit new record highs for lots of the geopolitical stuff you mentioned earlier and various other things, including the Department of Justice launching a criminal probe into Jerome Powell, head of the Federal Reserve. These are not things I expected to be saying this year, but there we go. There's lots of those at the moment. So what's happening with the gold and silver markets, the latter, which seems to have gone parabolic? What does it mean, and how should we treat that within portfolios?
Well, there's a famous investment saying, which is the four most dangerous words in investing are "this time it's different." But it does feel a bit different this time, in fact, in gold and silver. Gold is at an all-time ever record high. I probably said that last time, and it's yet again at an all-time ever record high, and has performed well again this year. Silver, as you say, has gone exponential, effectively parabolic, more recently. The driver for this, but in silver's case, silver's got a lot of industrial use. About half of all silver is used in industrial of purposes. Gold much less so, of course, but silver is a store of value as well, or seen as a store of value. And there are two or three things happening. First off, as we said, the industrial position is much better, or has been much better in the last 12 months than some expected. So industrial demand has come along. Silver is also required for some of these data center requirements, so it's benefited from that. But more fundamentally, both gold and silver are benefiting because investors and companies even around the world are concerned about the levels of government debt, these very high levels of government debt. We focused on these in the past, how whether you're in the US or the UK or France, all these big economies, or indeed Japan, which has had very high levels of government debt for years, it just doesn't seem sustainable on the paths we're at. We don't seem to be able to address that. As you mentioned earlier, the US is trying to do that through growth, the UK through I'm not sure what, but it doesn't feel sustainable. And the fear is that the outcome of all this, somewhere down the road, it could be 5 years, it could be 10 years, is that the governments around the world start to debase their currencies effectively, which is inflationary, and get rid of their government debt through that. So people are looking to find an alternative store of value. And that's one of the reasons gold has moved up to these levels. We've never had government debt at these levels in peacetime. When we're in a period of economic growth, I think that's really what's gone on, and that has also, I think you said last time, bizarrely, Mr. Crypto, that has also been one of the reasons, although it's highly volatile and Bitcoin has recently come back very sharply, that crypto has also been benefiting from sharp rises over the last 3 years as well.
Well, I'm going to give you another difficult question. This one actually. It's from must be one of our more pessimistic clients, because said, "Is AI going to end us all?" I don't know they're talking about specific about you or my job, Richard, but you can give some quick segue into that. But there we go.
Well, that's a fair point about our jobs. Well, look, there are some. I think they're called AI doomers out there who think that AI is going to get out of control. It's going to make itself better and better and better very quickly. And quite suddenly, not just us, Tom, but I'm afraid everyone else in the rest of the world will be without a job. And where do we go from there? I think that's overdone. Obviously, there are some people who know lots more about AI who have said some of these things, but I think it's overdone. And the way I see this is it's much more analogous to what happened with the internet back 25 years ago. We will find ways of using AI that we don't know at the moment. We will be employing it across a wide sphere, healthcare, governments, I'm afraid. We can already see one or two companies doing that. And in finance and in industry to make us more productive. And I'm more of an optimist. I don't see AI ending us. I see it helping us. But certainly there are going to be some challenges ahead about deep fakes. We've seen the discussions about Meta in the UK and some of the unpleasant things that Elon Musk's lot Grok can do. All of these things are concerns, but I broadly think that AI will be a boon to us over time. And I'm more of an optimist than someone who thinks that it's going to destroy us all. Well, thanks for those, Tom. I'm going to get my own back now because I also have seen the questions. So I think there are a couple which are just made for you. I'll start with one about private credit. This is sort of debt which is not listed on public markets, and there were a few news items, in fact, some wobbles, I think it's fair to say, in the private credit market towards the end of last year, which some people have seen as a canary in the coal mine, and that it presages bad news for bonds more widely. What's your view on that?
Yeah, they're described at the time by Jamie Dimon, who is the chairman and CEO of the world's largest bank, JP Morgan, as being cockroaches, and implying perhaps there was something a bit more rotten in the system. Jamie Dimon would have access to far more information than you and I, but I think he's probably erring slightly too pessimistic. I mean, broadly, if you think about it, if interest rates are coming down and the economy is growing and corporate profits are growing, the prospect of systemic corporate defaults, I think, is remote. That's not to say there won't be further cockroaches, but I think that those problems are remote. However, this is good for our clients. 15 years ago, 10 years ago, arguably even 5 years ago, those cockroaches would have been coming to public bond markets to issue debt that would have been included in high yield bond universes and included within high yield bond funds. Hopefully, the people we employ to do that for us don't pick those aforementioned cockroaches. But that would have created a negative potential landmine situation for us to step on. I think most of those sketchy borrowers and some of those more concerning issues are now in the private credit funds, where they have to really reach for risk and extend to try and get the yields that their clients are justifying. So the clients are wanting to justify their very high fees. I think a lot of those problems in private credit markets, but they do also have the ability, and some might remember this term from 15, 20 years ago, the financial crisis, to extend and pretend. They can sort of hide these in these funds because ultimately there's not the same insight that we have into public debt markets. So is this a major issue? No, I don't think so. Will there be some, individual idiosyncratic issues? Undoubtedly. Does that weaken the outlook for our client portfolios? No, I'm not sure it does. In fact, if anything, I think actually we could be in a better place because of them.
Yeah, it's good to have that kind of debt in the right place, because I think it's fair to say public markets aren't ideally suited for that kind.
Yeah, keep it as far away from us as possible, and we are doing.
Agreed. Yeah. I think we've got time for one more before we close. It's a question we often get, and it's a valid question on each occasion because it never goes away. But we've been asked, obviously, we mentioned earlier that the dollar had a weak phase at the beginning of last year. Where do we see the dollar going against sterling in 2026?
That was all going so well to Ben. I think I'd probably rather have the AI Duma question. Let's try and keep this succinct and sensible. I guess we don't really know, but we have to have a view. Our suspicion has been for a long time that there was a post-Brexit trading range of roughly 119 to 136. There were brief spurts above and below that because of extreme political situations, but that range typically held. We are towards the top end of that range in terms of sterling having outperformed. But my suspicion is, and I'm sure the team would agree, that we probably stay within that range and are quite volatile within that range for these reasons. Interest rates in the UK, the US are likely to be similar. So we expect 2 interest rate cuts in both, ending up with sort of terminal rates of 3.25 in both the UK and the US. Economic momentum in the US is much better, yes, than in the UK, but they do have even more political uncertainty than we have. And I think the other point to note is whereas the US economy might be stronger, the US government either implicitly or explicitly is trying to find ways to weaken the dollar. So that probably means that the pound and dollar end up in a sort of high scoring draw type situation, which equates to volatile and probably not being too far away from where we are now. To be clear, we do have to implement currency views in client portfolios, but those views are not sufficiently strong at the moment that we would be taking action. I think that's the best way to describe it. So ultimately, the cable rate will be volatile, but probably not dissimilar to where we are now as we come to future webinars.
Thanks, Tom. And just to reiterate, we only really take currency views when we do in equities. We always
agreed
fixed interest exposure. So thank you very much, ladies and gentlemen, for your attention. I hope we haven't disappointed you with our views on 2026 as we go forward. It is going to be an interesting year in that Chinese sense of please protect us from interesting times, but we're here to help you through that. I think there are good opportunities as we've outlined. And of course, we'll update you again in the beginning of the second quarter when we've got much better visibility about what's going on and what has gone on. In the meantime, I wish you all the very best for 26 and look forward to seeing you again very shortly.
Thank you.